Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Lead Partner. Welcome to our June 2014 IFRS Insurance Webcast. The last and longest mile. The ISB starts its redeliberations on participating contracts is today's webcast title. Obviously, the focus of today's webcast will be on the participating contracts discussion that has now started to pick up pace. As always, the webcast will be structured on 3 agenda items we traditionally use to present the developments to you. Highlights of decisions from the ISB meetings this month, a deep dive and the longest session of the webcast around the recommendations that were put forward by the ISB staff and the board discussions around those. And finally, a few minutes on the next steps and update on the timetable. The highlights for this webcast all come from the meeting held last week on Tuesday, the 17th of June, when the ISB really moved one notch up on the engagement for the discussion and decision-making activity on the accounting for participating contracts. They moved on from the educational session held in May, and this month they undertook another educational session, but the difference is that it was done with votes to give directional views to the staff so that they can develop recommendations for final decision-making activity on 2 key issues. The first one is the unlocking of the CSM with the insurer's share of underlying items on the basis that it represents implicit revenue. And the second is a book yield approach for the presentation of time value of money and the restrictions that should apply to that approach in the final IFRS. In addition to these important developments, we've also continued to see a very rapid pace of decision-making activity on all other areas. And the last 3 of the 7 non-targeted areas that were planned for discussion have already been decided upon. This month, we have decisions on guidance on discount rates for long durations when there is no or limited observable market interest rate data, a decision on the level of required CSM aggregation or granularity, and a decision that revises the accounting treatment for the no-gain rule on reinsurance assets. But without any further ado, let's move on into the participating contract discussion and see the recommendations and the discussion that followed. The first topic was the accounting of the CSM and the unlocking mechanism to incorporate also the insurer's share of underlying items. The paper of the ISB staff presented the issue, first of all, and noted that the 2013 exposure draft mirroring approach has been rejected by several commentators as too complicated compared to the benefits that it would deliver, and for many other reasons. Deloitte was one of those proponents of removal of the mirroring approach from the final IFRS. A number of parties, and Deloitte was again one of those, proposed an alternative approach to this mirroring exception, and this alternative is built on the existing accounting treatment for insurance contracts, the building blocks approach, modified such that the unlocking of the CSM for those contracts with participating features include also the insurer's share of the returns on underlying items. The insurer's share can be viewed as either an implicit management fee or the insurer's economic interest in the underlying items. The staff analyzed what would be the accounting implication from their perspective if one of these 2 alternative views was taken. They concluded that, in their opinion, the adjustment of the CSM for changes in the estimate of the insurer's share, if it represents economic interest in that group of underlying items, would go beyond the proposal of the 2013 exposure draft because it would not be justified from a conceptual basis as relating to future services. Because of that conclusion, the staff argued changes in estimates of the insurer's share would be recognized immediately in profit or loss, therefore preventing the IASB to taking that basis as the basis for adjusting the CSM unlocking mechanism for participating business. On the grounds of that analysis, the staff recommended that the IASB could require an entity to adjust the CSM for the insurer's share on the grounds that it represents an implicit management fee and not the insurer's interest in the underlying items, but only under certain conditions. And these three conditions are: the first, that the return to be passed to the policyholder arise from the underlying items the entity holds. Now, interestingly, this condition is alleviated by the fact that these underlying items held by the entity are held irrespective of whether those items are in the balance sheet of the insurance company because of contractual or entirely discretionary decisions of the insurer. The second recommendation is to restrict these adjustments to the CSM for a third component when there is a minimum fixed or determinable amount that the entity must retain. Now, I want to draw your attention to the combined effect of these two conditions before we move to the third one, because I believe personally that the alleviation that is introduced in the first condition is substantially reduced by the second condition. For a compulsive retention situation to be in place, I believe that it is reasonable to expect that some form of contractual or regulatory or statutory obligation should exist in order to enforce that compulsion on the insurer. So I believe that the condition of a minimum fixed or determinable amount could be read as potentially limiting the freedom that appears to be granted under the first condition in terms of the absence of requirements to hold underlying items. The third condition is that the policyholder will receive a substantial share of the total return on underlying items. Let's have a look at the discussion that followed this recommendation. The first point that we wanted to draw your attention from the debate is that a number of board members were concerned with the overall approach that this paper presented to them. They are of the view that the IASB must develop accounting standards following a logical order, which requires first to debate the conceptual issues and then develop principles and application guidance accordingly. And they felt that this approach was reversing that logical order, and they were feeling uncomfortable with that. They also observed that this unlocking with a third element would introduce complexity. Now, the third element is the insurer's share of the underlying items. The other two elements, is perhaps worth reminding ourselves, are the expected inflows and expected outflows from the contract. Those are the elements which generate the unlocking of the CSM as they are revised, because revision on the assumptions and the value of those cash flows in the balance sheet of the insurance contract will be captured by the unearned profits represented by the contractual service margin liability. For a participating contract, there would also be a third element, being the insurer's share revised estimate. The staff stated also that guidance will be provided in the final text of the standard to explain what constituted a substantial share of the total return on the underlying items. So we should expect guidance as to that particular condition. We noted that some board members raised some concern that if all the adjustments for participating contracts essentially ended up adjusting the CSM, these would result in a smoother mechanism as far as the net result is concerned, and would also undermine potentially the main performance indicator represented by that figure. Finally, there's been a number of board members during the debate highlighting the fact that they would expect that whatever is the outcome of this debate, there should be consistency demonstrated to them by the staff that Contracts with explicit management fees will be accounted for in a similar way if they are economically similar to participating contracts where implicit management fees exist. After all this discussion, 11 members agreed with the first two recommendations against 4, and 12 members agreed with only 3 dissenting members disagreeing with the third recommendation. It's important to observe that 1 board member was absent on the day, and that's why the sum of all the votes you're going to see through the webcast lead us to a total of 15 board members out of the 16 currently appointed. The staff moved the discussion to the next question around the insurer's share of underlying items, which is what amounts should adjust the CSM. The issue here is that there are different views on the various proposals put on the table as to what will be the amount that will adjust the CSM, if the IASB, of course, were to agree in principle that the CSM should be adjusted for changes in estimates of the insurer's share. The discussion led to a conclusion that it would be done in a way that the insurer's share would be measured consistently with the measurement of the fulfillment cash flows, and it would be determined on a basis that reflects the effect of the equivalent changes in estimates of the underlying items in profit or loss. Now, when Deloitte put forward our proposal, we actually dealt with this issue, and we explained that in our understanding of the logic of the building blocks approach for participating contracts, the application guidance covered by paragraph B66K of the exposure draft is quite clear in terms of projecting the expected payouts to current and future participating policyholders as they will be derived from the underlying items. Our proposal for the unlocking of the CSM, inclusive of the insurer's share, is a mere application of the same projected calculations that would apply to the policyholder share. And so we would very much support that requirement in the first bullet. The second bullet appears to be less clear from the debate, and it will be important for all of us to continue to observe and establish an effective constructive dialogue with the IASB and the staff. It is interesting that the IASB staff is going to develop these guidance on the grounds that equivalent changes in the estimates of the underlying items being reported to profit or loss should be reflected. That could be giving us an indication that potentially there are already some ideas as to the effective release pattern that this modified CSM could have. We will see. The Deloitte proposal dealt with this matter, and we established that the release of the CSM need to be constructed by looking at the substance of the obligation that the insurance company has contracted by issuing a participating contract. And again, linking back with the correct principle of estimation of payout based on the underlying items, and the fact that those payouts may be awarded to current or future policyholders, we concluded that it is the award that represents the most important indicator of the fulfillment of the obligation contracted. And because the fulfillment of the obligation is the key driver to the release of the contractual service margin to profit or loss, that represents to us an important factor to be considered in determining the earning pattern of the CSM. So the declaration of those returns and the award of the returns to the policyholders will represent fulfillment of the obligation and the reduction of the CSM liability with a corresponding result release of that liability to profit or loss. But clearly, we know that others have different views on this particular matter, and this is why the issue on the table is a delicate one. The second part of the participating features discussion is around the book yield approach, and the discussion was all around the merits of having such an amendment to the building blocks approach. The analysis of the staff explained that this approach only related to presentation. It's not a measurement, if the recommendation that comes from several parties to adopt a building blocks approach for the measurement of the liability on the balance sheet is adopted, the mirroring exception was actually creating an anomaly in that regard, because the reflection of amortized cost-based underlying items would have created a liability different from the building blocks. Same products would have been measured with a different liability if the underlying items were accounted for on different bases. That is no longer the case, and so it becomes a mere presentation with the same balance sheet and potentially the split of the time value between profit and loss and the OCI. On that basis, the book yield approach should be applied only when the returns to policyholders arise from the underlying items that the entity holds, regardless of whether they are held as a result of statutory, contractual, or discretionary decisions of the insurer, and the policyholder will receive a substantial share of the total return on the underlying items. You can see here that the first and the third condition recommended by the staff for the CSM unlocking are replicated as the conditions to allow the use of the book yield approach. Book yield approach, which is also conditional to the choice of the insurer to use the OCI solution, without an election on a portfolio basis, as was decided in March earlier this year, that insurer would not be interested in using the book yield approach. So it's an important point to bear in mind in this regard. The discussion acknowledged that this is a similar approach to the OCI solution for non-participating contracts, but there is added complexity. One discount rate to determine the balance sheet's value, and another for presentation purposes, like for non-participating contracts. But the use of the book yield approach, where the criteria to be met and the OCI approach for all other cases may actually result in more complexity. Now, clearly, you should appreciate that complexity is often an argument that commentators have been using to criticize proposals from the ISB, and so a lot of board members have become very sensitive to any changes in their proposal that actually could introduce complexity, and there is almost like a defense mechanism being triggered anytime new proposals are brought to the board for discussion that appear to complicate further an existing set of requirements. The staff also confirmed that the book yield would be determined at each reporting date, reflecting the current composition of the underlying items. Any differences between the interest charge in profit or loss and the impact of the discount rate in measuring the contract liability will be included in OCI. There was disagreement, we noted, on the fact that the book yield approach would not lead to significant differences to other alternatives for determining the unwind of the discount rate in profit and loss and the amount in OCI. It's questionable here whether that is the case, but we believe that only on a case-by-case quantitative analysis you can establish whether the OCI reserve will effectively be larger with the book yield approach or not, compared to a locked-in discount rate on inception of the participating contract. Given the more limited controversy associated with this idea, you might say, we can see here that there is a large majority of 12 board members in support, with only 3 in disagreement. Let me now take you through the non-targeted issues discussion at the board's meeting last week. The first one I want to talk about is the decision to determine whether additional guidance should be introduced in the final IFRS when discount rates have to be determined with a limited or no observable interest rate data. Then the staff analyzed that both the measurement approach in the 2013 exposure draft and the fair value approach contained within IFRS 13 place the same reliance on observable market information when applying valuation techniques to liabilities which are not held by other parties as assets. For example, a liability which would be held by other parties as an asset is a debt security. Insurance contracts are not necessarily assets of the policyholder. Nevertheless, there is a need for reliance to be applied in the valuation of the discount rate. and when observable market prices exist in active markets, they should be used. However, prices for the whole of the contract doesn't normally exist, and therefore a valuation technique is necessary. Several comment letters sought clarification on what type of approaches would an insurer be allowed to use under the new IFRS to extrapolate or extend the discount rate yield curve beyond the period for which there are observable interest rates in active markets. And depending on the currency, that period could be significant and very material. The recommendation from the staff, in my personal opinion, and you will see that in a moment for yourself, introduces a degree of clarification, but substantially repackages concepts and requirements and the guidance that was already present in the 2013 exposure draft text. The first recommendation is that there should be a confirmation of the market consistent principle for discount rates based on the cash flows characteristics of the insurance contract. The second is that there should be in the final IFRS additional application guidance that in determining those discount rates, an entity should use judgment to, first of all, ensure that the appropriate adjustments are made to observable interest rates to reflect the characteristics of the cash flows of the insurance contract, and second, that they develop any observable inputs, any unobservable inputs, using the best information available in the circumstances. And this is the important part, while remaining consistent with the objective of reflecting how market participants assess those inputs and without contradicting observable market data. So there is a degree of consistency. The first one with the market participant perspective, the second one with other market data which is observable. In my opinion, all these elements were actually present in the guidance of this project draft published last year. But what we should expect now is a much more clear exposition of those principles and guidance so that it will be easier, allegedly, to implement them in practice. And I leave it to the eye of the beholder to decide whether these will be actually sufficient for those of you who actually call for that additional guidance to be published, to decide whether these will actually satisfy your wish. You can imagine the discussion here to be very supportive, and indeed that was the case. And in fact, you can see already at the bottom of the slide, the vote was unanimous in support of the staff recommendation. So the key points we took away from observing the discussion is that there was obviously confirmation of the board member support for the refinements included in the staff papers. There was also an indication that the need to explain the rationale for making the adjustments from market observable data should trigger disclosure requirements, which again, we believe were already there in the exposure draft, and they would only need to be refined and clarified better in the final text. Equally, the importance of critical judgments was already included in the draft of the standard published last year, but obviously there will be more emphasis in the new version on the disclosure for the extrapolation beyond the horizon of observable interest rates. And finally, there was agreement among many board members that the principles in IFRS 13 will still apply to the discount rate, the second building block of the insurance contract accounting model, even if insurance contracts are not fair valued. And as I said, unanimous votes came in support of these recommendations. The next topic I want to talk about is the asymmetrical treatment of gains from reinsurance contracts held. In 2013, the ISB introduced a new rule compared to the previous draft of the standard, which prohibited the recognition of any gain on purchase of reinsurance contracts. The gain would arise when, by measuring as required the insurance assets with reference to the insurance liability that is being reinsured, you recognized as a company, as a preparer, insurance assets which may be larger than the consideration paid to acquire the insurance protection. In 2010, that would have been generating a revenue, an income, a gain in the profit or loss. That gain has been removed in the 2013 exposure draft, and the insurance assets need to be reduced to calibrate the premium paid with the creation of an implicit liability within that asset being a reinsurance CSM liability, which is then taken to profit and loss as income over the coverage period of the acquired reinsurance contract. The staff analysis indicates that there could be different considerations to be considered after initial recognition. And in particular, changes in estimates of cash outflows, payouts from the reinsured insurance contracts, they have a corresponding change in the cash inflows, i.e. reinsurance recoveries, from a reinsurance contract held, should have no effect in profit or loss for the period, because there is reinsurance. In addition, when a reinsured portfolio becomes onerous, changes in estimates of the cash flows from the reinsurance asset should also be recognized in profit or loss to reflect the protection received from the reinsurance contracts held. So that analysis led the ISB staff to a recommendation that cedents should recognize in profit or loss any changes in estimates of cash flows of reinsurance contracts held whenever changes in the cash flows of the reinsured insurance contracts are recognized immediately in profit or loss. During the discussion, the staff confirmed that they believe cedents can identify changes in reinsurance contracts cash flows, and therefore it is practically possible to implement this new requirement. And they also assured the ISB members that the trigger for this gain, for this reinsurance gain, is effectively an onerous portfolio loss. Given the analysis and the rationale presented, also this targeted recommendation was unanimously approved by the ISB members. So let me take you now to the third and final of the non-targeted issues discussed, and also the final one of the 7 planned for discussion in the redeliberation phase. This is around the body of new guidance that the ISB may include in the final text to clarify the level of aggregation and granularity that needs to be applied to portfolios and subcomponents of those portfolios. What the ISB staff came forward with is a series of recommendations. The first one is a point of clarification. So the standard should clarify that it provides principles for the measurement of an individual insurance contract, but an entity could aggregate insurance contracts in a portfolio if that aggregation does not remove away the measurement from that overarching objective. And again, this was already present in the text of the last 2 exposure drafts that we read, so this was purely a recommendation to make that even more explicit and clear in the final text. The second recommendation is to amend the definition of a portfolio, and that's perhaps one that requires a little bit of attention and discussion here. The portfolio was defined in Appendix A of the 2013 exposure draft, and what the staff is proposing is a short definition that defines the portfolio as a group of insurance contracts that provide coverage for similar risks and are managed together as a single pool. This new definition results from the deletion of the requirement that that group of contracts combines contracts which are priced similarly relative to the risk taken on. So that requirement is now being removed. The third recommendation is that there should be guidance, application guidance, which is a requirement for the CSM group of contracts. And on initial recognition, the CSM should not combine onerous contracts with profit-making contracts. And then in subsequent measurement, the CSM should be accounted for by combining contracts that have similar release patterns, absolute amounts of CSM at initial recognition, and similar inception dates and coverage periods. So 4 dimensions. Now let's have a look at what followed from this recommendation. And you can see that from the slide, this third recommendation is the one that really triggered the most debate. The ISB accepted the recommendation to clarify the portfolio versus individual contract approach on a probability statistical basis, accepted also the revised definition of a portfolio, with the removal of the pricing requirement. But there was a lot of discussion on the third recommendation, in particular, this dimension of similar absolute amount of CSM. When Deloitte put forward our recommendation on how to improve and clarify the level of aggregation and granularity around CSM accounting, we did recommend 3 of the 4 positions. We recommended a similar release pattern, similar inception date, and similar duration. But we didn't recommend the similar amount. And interestingly, a number of board members actually were puzzled by that. And so the staff explained that that criterion was introduced because of their objective to avoid having contracts with large and small CSMs being included in the same portfolio. If the contracts with the small CSM became onerous because of their more limited profit cushion, it would be possible that the presence of contracts with large CSM would still lead to no onerous contract loss recognition for that portfolio, because the large CSM contracts would actually absorb the losses on those contracts with the small CSM. And the staff believed that that was not good accounting. In addition, they felt that different levels of absolute CSMs by contract would lead then to a more delicate requirements in terms of estimating lapses for the determination of the earning pattern, as discussed and agreed for non-participating contracts, at least during the discussion and decisions in May. That explanation did not appear to be persuasive enough, and there was no support for the third recommendation as drafted. The ISB members instead preferred to remove that from the application guidance, so to speak, and include it in the standard as examples to be provided for explaining how the principle already enunciated in the standard should be applied, rather than introducing that as a strict requirement. On that amendment, all of the board members approved it, and then only one voted against the other 2 recommendations. So on that basis, a revised basis, we have a very large majority again scoring another important step forward towards completion of this project. After this discussion on portfolio and CSM groups, the staff introduced another topic in terms of level of aggregation, building on the decision the board reached in March on the OCI solution. As you remember, that decision led to the decision of the board to elect the OCI solution by an accounting policy. An accounting policy choice that can be made on a portfolio-by-portfolio basis. So it's important here to establish what kind of portfolio is the ISB talking about in that respect. And the proposal is to use a portfolio that considers the contracts as aggregated based on the definition in Appendix A, the one that was just revised earlier, and the related assets that the entity holds. There were concerns on that recommendation that the inability sometimes to identify those assets could create diversity in practice and limited comparability. And so the ISB decided to introduce a third element in that requirement for the portfolio definition on the OCI accounting policy election, which is the accounting basis for the assets. So is the assets held, is the portfolio of insurance contracts, and the way the assets held are accounted for. Only 10 members were satisfied with that amendment. The other 5 voted against it. And so this is perhaps the lowest majority achieved by the staff with their work in the meeting last week, but it's still a fairly large one compared to the majorities we were used to see during the work that led to the 2013 exposure draft. That was the last of the decision-making discussions at the meeting last week. So let me just take you through the last item on our agenda, which is the next steps and update on the timetable. The ISB plans to continue its discussion on the adaptations of its tentative decisions that would be needed for contracts with participating features over July and September meetings. That's an understanding that Deloitte have acquired from discussion with the ISB staff. That's why also we decided to call today's webcast the last and the longest race, the last mile of the ISB redeliberation process. Once that is done, the remaining issues to be discussed in future ISB meetings, and potentially could be done also in July and September, for contracts which do not have participating features, will include the discount rate to be used to determine the present value of cash flows that adjust the CSM, and also used to accrete interest on the CSM, and the follow-up of issues relating the OCI solution and the premium allocation approach that have not been dealt with as yet. So a fairly limited number of items, and the accretion rate in particular is not one that potentially may attract your attention, but I would encourage you to pay attention to it, because it has got some important practical implications. It is potentially the only requirement remaining in place for all insurers, whether they do or do not choose to elect portfolios for the OCI solution, to lock into their systems historical discount rates which were market consistent at the point of issue of the contract, which is clearly an onerous system requirement to be dealt with. Once this is all done, the only final targeted topic that remains to be discussed is the transition requirements for the first-time adoption of the new standard, including the effective date of the new IFRS on insurance contracts. Now, all that being said, the ISB expects the redeliberation to be completed this year, with the publication of the final standard in the first half of next year. And if the pace remains as it has been observed to date, it may be that that publication will take place in the earlier part of the first half of 2015. At that point, we should also observe what the final mandatory effective date of the new standard will be. We know that the ISB is committed to give approximately 3 years from the publication date of the standard, and that would indicate that the 1st of January 2018 could be a good candidate. It is the candidate date that Deloitte believes is the most likely at this stage, with all things being the same. It also has the attraction of aligning the mandatory effective date of the new IFRS on insurance contracts with the mandatory effective date of IFRS 9 financial instruments. And that is certainly a very welcome situation that several comment letters encourage the ISB to strive to achieve. And it would seem to be a pity if the ISB doesn't take advantage of its recent decision to move forward the effective date of IFRS 9 to do its best to align it fully with the IFRS 4 Phase 2 effective date. That is my last point for today's webcast. And as I turn to the last page, reminding you of the collateral that Deloitte continues to put out to help you follow as conveniently as possible the final developments of this project, I would like to invite you to put forward your questions, and at the same time ask Courtney to stop the recording of the webcast.